Welcome to all of you. This is our third in a series of webinars that we've been given on the tax changes in various countries in the region and how the tax impacts on doing business in that region. We've had some discussions on the proposed changes in South Africa and Tanzania so far, and this morning we're going to be focusing on Zambia. I'd like to just run through briefly some housekeeping rules to enhance the webinar experience for all of you. As has become normal in these things, you're all being muted automatically and the chat function has been disabled. If you have questions, please pop them into the Q&A tab at the bottom of your screen, and the questions will be submitted to me and to the panel, and we'll deal with them at the appropriate time during the webinar. We won't be giving any written answers to questions raised, so please try to raise them as soon as you can during the webinar. However, we will be recording this webinar and it'll be available on our website later today. That's at www.bowmanslaw.com. My name is Barry Garven. I'm the head of tax at Bowman's in our Johannesburg office. The other panelists are my colleague Bwalya Chilufya-Musonda. She's a partner in our Zambian office in Lusaka. We have, hi Bwalya, we have Michael Phiri, who's a partner at KPMG in Zambia. Morning to you, Michael.
Morning.
And we have Mutisunge Zulu, who is an economist. We'll be starting off with Mutisunge, but before I come to him, I'll just explain how we set this out. We're going to be going through the tax aspects of the budget as per sector. So we'll start at dealing with issues dealing with the manufacturing sector, and we'll walk through some of the other sectors such as mining, agriculture, etc., transport, just to give you a feel as to how the tax impacts will affect people operating in those areas. And then towards the end, Bwalya will give a talk about how the tax will change new investments into Zambia, M&A deals and things like that. So over to you, Mutisunge. You're going to give us a brief outline of how the budget raises topical issues for Zambia. Over to you. Thank you.
Thank you so much, Barry, and good morning to our viewers. So I'm going to give you a high-level overview of where we're at. Interesting times we're living in for business purposes. We're coming from a very, very turbulent year. Of course, COVID-19 did affect everyone across the world, Africa and Zambia as well. And then that obviously did have a toll on the economic environment. But as for Zambia, I think it was a very interesting period because not only did we go through COVID, but at the same time, we did head to the polls in August, and the outcome was pretty much self-explanatory. So we have a 7th Republican president, and because of that, I think that it's on the back of which political risks have pretty much subsided. And what we are seeing now is confidence, sentiment back into the Zambian economy. So there seems to be this risk appetite that is coming back. Everything is looking positive. That's from mining to manufacturing, agriculture, and we're getting flows back. We're getting people more interested in Zambia. So after August, of course, we did see a number of things happen. You can see demand for our government securities, that's investor flows. You could see that the currency has started to appreciate, and I think it did move significantly. And I think those factors are very good for business. And we're getting people knocking on Zambia's doors, thinking of opportunities and where to invest. But then after the election in August, I guess we moved on to the budget, and the budget is merely a strategic roadmap as to what we should expect in 2022. So I do understand that the budget is coming at a time when you have a 9th National Development Plan that is yet to come out, and the budget should just be a snippet of it. So the 9th Development Plan is yet to come out, and I think that would then provide a greater roadmap for the next 5 years. But I think there had to be a budget because we're slowly getting into 2022. So some of the interesting things that we see there are a clear debt redemption. And I think debt has been very topical for Zambia. I talked about COVID-19 because why? It actually amplified fiscal posture. So fiscal fragility is just like any other African country. And then we defaulted on coupon payments. We were default rated by rating agencies. And that was actually very difficult because the cost of doing business actually went up. But we're seeing the opposite of that. So now we see a clearer, there's never been a time in the history of Zambia that we saw political will to address some of the fiscal issues and the maturity to own some of the challenges and hurdles that Zambia has. And then with that said, I guess that's what creditors have been looking at. So we have a $10 billion, which is about 173 billion kwacha budget. Of course, resources are scarce. So you have a minister that is trying to make do with the scarce resources that he has. So I'm sure if he had more resources, it would be a different budget. But I think one thing that stands out clearly, there is more realization that it is the private sector that drives growth. So I think in this budget, you will get to see that there's a lot of things that actually speak to the private sector, because they're the ones that drive growth. Then they start to create employment, start to grow this economy, and then your obligations get dwarfed. So in a nutshell, we are seeing clarity around things like an IMF deal, restructure of obligations. And should that happen, I guess a lot of resources will be freed to other sectors of the economy that have really, really struggled over the years. So in a nutshell, I would say the outlook is looking positive. We are cautiously optimistic. We are positive. The minister was very clear in asking everybody to rally behind him so that by end of November, we get onto a program, first quarter of next year, debt restructure, and I guess the rest will follow. So at this point, in a nutshell, I'd say, yes, it's an ambitious budget, but we are fairly optimistic about the outlook of Africa's second largest cocoa producer. Thank you.
Thanks, Mutisunge. So some optimistic thoughts there from you. Thank you very much. Obviously, a very important sector for Zambia is the manufacturing sector. So I'm going to ask Bwalya to chat about the tax changes that have been proposed for that sector and how it's likely to impact them. Over to you, Bwalya.
Thank you, Barry, and thanks, Mutisunge, for that introduction. And yes, against the backdrop of the COVID-19 pandemic, the government's focus, and as has been alluded to, is to grow Zambia's economy by increasing production and manufacturing activity. The sole aim is to make Zambia a net exporter of goods and services. And in order to realize these ambitions, government has proposed in its national budget a reduction of the standard corporate income tax rate to 30% from 35%. But the top marginal tax rate for telecom companies will remain at 40%. There has been proposed a suspension of corporate income tax for persons carrying on business of manufacturing ceramic products for the charge years 2022 and 2023. And for those in the tourism business, there's been an extension of the 15% corporate income tax rate, which was introduced in the 2021 budget, and this has been extended to 2022. So corporate income tax has been reduced to 15%. In relation to manufacturing, government intends to increase activity in the multi-facility economic zones and the industrial parks in an effort, again, to make Zambia a net exporter of goods and services, and in readiness for the African Continental Free Trade Agreement. So the full potential of these multi-facility economic zones has not been realized from the time I think the idea was introduced in 2005. For example, we have the Lusaka South multi-facility economic zone, which is quite close to us. It's begun its operations in 2010. And from then, it's reported 62 companies that have been approved to operate in its zone, and 17 are operational. And then 31 are in the process of obtaining sector approvals, whilst 14 are at different stages of construction. So when you look at the number of 17 companies being operational against the 62 that were approved to operate in the zone, you can definitely tell that there is need to revamp these zones and industrial parks, and government's attention to these areas is quite welcome. And some of the incentives that have been introduced to operate in the zones is there's going to be a 0% tax for a period of 10 years from the time you begin your works on dividends declared on profits made on exports. And there's also 0% tax, again, for a period of 10 years for profits made on exports. There's also going to be an increase after the 10-year period to 50% of profits made on exports for the years from year 11 until year 13. And this will increase to 75% of profits for the years 14 and 11. I think what definitely stands out is the emphasis on exports, and it's quite clear that the incentives are to try and increase exports in the sector and in the market in general. There's also been a reduction of the threshold for Zambian citizens to qualify for incentives provided under the Zambian Development Agency Act to 50,000. And the intention here also is to try and increase local participation. What we have seen is not necessarily an exclusion of one particular increasing investor confidence, but it's really a broad approach by local investment by Zambians. Thanks, Barry.
Thanks, Bwalya. Very interesting insights there. I see that the corporate tax rate is going to be reduced, no doubt, to try to make Zambia more competitive as regards some of the other countries. Do you know, Bwalya, we have a question on this. Do you know when the reduced rate will become effective from? Has it been announced yet?
So the reduced rate will become effective from the 1st of January. So what this will require is that, in as much as some of these pronouncements have been made, they will require Parliament to pass laws to basically back them up. And we expect these bills to be passed by the end of the year. So Parliament will be busy with drafting bills and approving these bills. So the proposals are supposed to take effect on the 1st of January, 2022.
Thanks very much. Michael, over to you for your thoughts on the mining sector and the tax changes proposed for that.
Indeed, thank you very much. The way we look at budgets, I like to look at it from a perspective of winners and losers. And in this budget, I can confidently say that the mining sector is one of the winners on the budget changes that were announced by the minister. Winners from a perspective that the changes that have been made will really help to spur further investments into the mining sector, as well as encourage other investors to come into Zambia, which has been a key challenge that we've had in Zambia from a perspective that a number of investors were unable to come into Zambia because of the sort of tax regime that we had. And in particular, one of the problematic areas was to do with the mineral royalty tax. And so a few years ago, the government decided that mining companies would not be allowed to claim as an expense their mineral royalty tax that they pay on the minerals that are extracted out of Zambia. So this mineral royalty tax is based on the London Metal Exchange prices. So it's referenced to the London Metal Exchange prices. So notwithstanding what your agreed terms of pricing that you've agreed with your respective buyers, the mineral royalty would always be referenced to the London Metal Exchange prices. And so when that particular expense by way of mineral royalty was not allowed, it did affect new investments into the sector, as well as new improvements to the existing mines, simply because when you model and you put in your financial model and want to see how you win and how you'll be able to get a return, how much you'll be able to get as a return on your investment. This particular non-deductibility was impacting negatively on future cash flows, and most of the investments were not bankable. The banks were not ready to be able to provide financing. And as a result, the sector suffered from poor liquidity coupled with the fact that the government also was not quick and thorough in providing refunds to the mining companies. And so they were starved of cash flow as a result, and people were not able to introduce, to come onto the Zambian mining market, and they were not also able to reinvest into the sector. And little wonder that a few companies had challenges. I'm sure you've heard it's been in the public media, among them KCM and Mopani Copper Mines, with investors exiting either intentionally or otherwise. And so this is the cure that was required to be able to facilitate further investment into the sector. And also another aspect which hampered investment is the fact that, again, a couple of years we did follow international practice by removing thin capitalization rules. In the past, there was a thin cap ratio of 3 to 1 for debt equity. So meaning that you could only have debt 3 times your equity. And if you exceeded that threshold, you are not allowed to claim the interest that arose as a result of exceeding that threshold of 3 times the debt to 1. Now, that too was impacting in terms of funders being able to fund, because a 3 to 1 ratio was a little punitive. But now we follow in the international practice of EBITDA. And for this EBITDA, if indeed your earnings before interest, dividends, tax, and amortization do not breach 30%, you were allowed to claim the interest. Now, if you were not able to claim the interest in a particular year, that interest was carried forward into a subsequent year. Now, the carry forward period for this interest was 5 years, meaning that you have to claim the interest in year 1 by the 5th year. Otherwise, you lose your ability to be able to claim that interest. And as you can imagine, mining is long-term. Your return period, your break-even period may be in excess of 5 years. And so by limiting to 5 years, it made it very difficult for the modeling, financial modeling that would normally do to assess whether a project was viable to be able to give a positive return. We're ending up with a negative return in many instances, because the companies would essentially be losing the interest expense that they would have otherwise benefited from. So this too has been cured. And so from a perspective of attracting investment in the sector, these budget changes have really been winning measures for the sector, as I said, from looking at it from a winners and losers perspective. Now, there's also some cure that they are trying to do, because most of the mining licenses and processing licenses, small scale especially, are held by individuals, and they are held primarily for speculation. And so they also passed a measure to try and just generate a bit of revenue from transactions pertaining to mineral processing rights, as well as other related licenses. If you're going to transfer those or an interest in those particular licenses, now you'll be subject to a property transfer tax of 10%. On overall perspective, the mining sector is really standing to gain. And I did highlight the fact that their VAT refunds as well were problematic, in the sense that it impacted the cash flow of the company. And we've seen that there's been deliberate steps by the administration of the Zambia Revenue Authority to begin to unlock, to begin to dismantle those areas that had accumulated, that began first with small refunds amounts that below 25,000 kwachas. They want to clear all that backlog, and they're also putting in place measures to ensure that the refunds do not continue to grow, and also to put in place plans that will be able to facilitate the dismantling of the VAT refunds, which are about $1 billion at the moment, so that are owed to the various mining sectors. Perhaps I can pause there, and maybe Mutisunge, you would like to come in on the agriculture and agro-processing sector?
Thank you, Michael, for that. I think from the agri perspective, I think we've seen a lot of 0 ratings. as highlighted on the slides there, on selected agricultural capital equipment. There's manure spreaders and all. And then we've also seen very, very interesting areas such as your combine harvesters, your animal feed mix, on refrigeration tax as well. And I think that the spirit with which this is being done is to foster agricultural diversification. I think for the longest of time, there's been so much concentration risk in corn, that's number one, which is your maize. And in Zambia, when you mention agriculture, people think of cows, which is your dairy, your meat, beef processing, and agriculture. I mean, and growing maize. But the reality is that agric is massive. Zambia has capacity to push up to 9 million metric tons. I think I did attend a workshop, an agric workshop, where it was said that Zambia and South Africa put together can actually feed Africa when it comes to maize. But clearly there is recognition that that potential has not fully been tapped, which provides an opportunity for those listening and looking to invest in agriculture. And I think that the policies and the structures around as well, if you look at maize export duty, that's for 10% that was scrapped. I think that was clearly to allow people to be able to export and take advantage of DRC prices. So what you have is a sector that is coming up. There is more realization that the sector can actually contribute to GDP growth more than what we can see. And if you look at a lot of these tax measures that have been put in, is to encourage people. Look at things like your excise duty on day-old chicks. I think we've had this issue of shortage of chickens and chicks, and that has actually impacted that business. So they will allow chicks to be imported at no cost at all in terms of taxation. And that should actually, deal all those sectors and allow growth of small scale farmers, for example, people that are involved in agribusiness to grow to a level of a commercial farmer. One thing that has been very painful for Zambia is that if you look at corn growing, that's your maize growing, a lot of it comes from your SMEs, but then they have been SMEs for the longest of times. So there seems to be this mechanism that does not allow them to grow. And because of some things that pertain to that, you find that your Food Reserve Agency, which is an agent of the government, has turned into a de facto commodities exchange, and people are not able to take advantage of prices that they would get on the international markets, for example, the DRC prices that I'm talking about. So with that said, there is vast opportunity in the sector for storage, that's number one, building of barns across constituencies. And if that were done, then we would start to talk about things like your discount financing, where farmers do not have to worry about taking their produce from the northern part to Lusaka, but they can take their produce within the constituencies and they can get warehouse receipts and take them to banks. So you'd actually see that these tax measures in themselves do bring in a lot of players such as your banks, your finance institutions to grow, pretty much the sector. So what we're seeing now is an agro-led structural diversification type of model. And I'm glad that Bwalya did touch on the manufacturing sector, because the World Bank actually did a paper and said the easiest way for Zambia to boost its manufacturing sector is to sort out its agri, because when you have produce, your produce needs to be packaged somehow. And that is what agro-processing is. And then with that said, clearly we are seeing these types of linkages shaping out. And I think in my earlier remarks, I did say that I think this budget does clearly spell out, and it throws low-hanging fruit to the private sector that should be able to take advantage of value addition to maximize opportunity in agri, boost manufacturing, and that would then speak to our transport. I mean, if everything can be addressed. So I think that is actually exciting. And one thing to mention also is that agriculture is one sector that is highly incentivized. I think every budget that has come in Zambia always has incentives on agri, but I think the sooner we start to look at those incentives and why exactly are those incentives being given, we'll understand that there is potential for value addition, and the like. And then lastly, I'll just talk about this mobilization of highly concessional financing for irrigation equipment, as well for small scale farmers. I think there is this drive there is this realization that the small-scale farmers do play a particular role, and it's a big role they play. But I think it would be nice to see these small-scale farmers actually transform into commercial farmers in the next 2-3 years, and that growth. But that cannot happen if the environment is not conducive enough. And the type of environment that we seek is one that this budget does spell out. So I guess in a nutshell, it's diversification, it's opportunities that need to be tapped, and it's the linkages and understanding how agri can actually link to the other sectors. So in a nutshell, that is what I had to say about this agri sector slide. Thank you.
Thanks very much, Mutisunge. Again, looks like some good news coming out for that sector. What I imagine is also a very important sector for the country is tourism. Michael, would you give us your thoughts on the changes that are likely to impact that sector?
Indeed, and just to agree with what both Bwalya and Mutisunge have said, this budget, the theme is growth, jobs, and bringing development closer to the people. And we do see that it speaks to these themes in many ways than one. And like Mutisunge was saying, I think what we are anxiously and cautiously anticipating is that the implementation will follow through, because on the face of it, the budget itself does look to be a very good budget, and it focuses on areas that will drive growth, among the manufacturing, and I did speak to mining, and Mutisunge has spoken to agriculture, all of which we have a competitive advantage as a country. From a manufacturing perspective, we call ourselves land-linked because we have a bigger market into the Congo and elsewhere that we can be able to exploit with our products. And then from a mining perspective, 70% of our foreign exchange revenues actually come from mining. And so it's a key export revenue earning industry, and is the backbone of our economy. And we do hope that it will continue to support other sectors like manufacturing and agriculture, so that we're not continue to be heavily dependent on mining into the future, especially now when we have good prices, and we are now looking forward to maximizing on the good prices of copper on the international market. So if some of that can be diversified into these sectors, then it will help to be able to sustain our economic growth when the prices of copper dip. And so another sector that was identified is the tourism sector. And as you know, Zambia is endowed with lots of wildlife, Fiona. We've got waterfalls and many things that tourists would be attracted to see. And so as a result of COVID, there's been a bit of a slowdown in terms of tourist travels into Zambia. And so the idea now is also to try and see if we can promote domestic tourism. And so, and to spur this sector, the company tax rate was reduced from 35% to 15%, and technically now has been reduced from 30% to 15% on hotels and lodges, the income that they earn on accommodation and food services. That has been subjected to 15%, and so this 15% was to run for 1 year, but now it's been extended further, so that companies operating in this sector can continue to pay tax at a reduced rate as a way of incentivizing people to invest in this particular sector, as well as giving it the breathing space that it needs in the light of the impact of COVID-19 on the sector. Now, there are other measures too that have been introduced, which include the reduction of visa fees for all categories of visas, tourist visas inclusive. In this area, we had hoped that they could do more by essentially scrapping off the visa fees for tourists But I guess there's also the aspect of generating revenue for the government that the minister might have been putting into consideration that made him reduce to 50%. The impact of this reduction we are yet to see, because also the visa fees are reciprocal. So if you charge visa fees and you enter to the UK, then we reciprocate and charge your visa fees. So we're hoping that by reducing by 50%, it will be an incentive to attract tourists into Zambia. Now, there were other measures that had to do with vehicles that are used for tourism. You know, if you drive in the game parks, you use specialized motor vehicles that are used for tourism. Again, those the duty has been suspended for another year to allow people to be able to import these through into Zambia and promote our tourism sector further. There are also other things mentioned in the budget, among them the desire to open up other corridors for tourism, because for now the tourism has been really centered around the southern part of Zambia. But there are plans to be able to open up other places where we equally have game, we have waterfalls, but they remain unexploited. And so we're thinking that as the development plan, the next national development plan is promulgated, there will be a bit more focus to open up these other areas, especially the northern and Wapula areas, to tourism, so as to grow the revenue and truly make this budget a growth budget for all sectors that are critical to the economy. Maybe I can pause here, Barry.
Yes, Michael. So again, I think some good news for many of us who would like to come and visit your country as tourists. So that's good. Let's hope it has, the budget has that effect, because I'm sure the sector in Zambia is, like South Africa, a sector that has suffered terribly under the pandemic and the various restrictions that had to be put in place. So another important sector, Bwalya, which I think has been dealt with in the budget, is the insurance sector. Could you chat about that for a few minutes? Thank you.
Yes, and thanks, Barry. So the insurance sector comes in and it's quite interesting, the approach that the government takes in relation to the insurance sector. And maybe just to provide some background, all contracts of insurance were subject to what was called an insurance premium levy. And this is at a rate of 3%. This was introduced in 2015. I think the intention was to increase the uptake of insurance products on the Zambian market, as well as to spur the growth of insurance companies in Zambia. But what we see in the proposed budget is that the government is proposing to remove that insurance premium levy at the price of 3%, and instead proposes to introduce VAT. And it has proposed to introduce VAT on property and non-life insurance contracts. Maybe just by way of comparison, VAT will be at 16% versus the insurance premium that was at 3%. This is purely, obviously, a way to increase revenue collection and to take advantage of the insurance sector, because it has grown quite significantly in the past 5 years. When we look at the description of where the VAT is applicable, we can tell that the insurance premium levy at 3% will continue on life insurance contracts. And I guess there's probably an acknowledgement that, or an attempt to try and encourage people to take out more life contracts. So 3% will still apply on the life contracts, whilst 16% VAT will now apply to property and non-life insurance. Obviously, what this will do is it will increase the price of insurance for the end consumers and the public, because obviously VAT being levied on the end users would not be refundable. Also, as a way of increasing revenue, and part of government's budget is that the minister has introduced a withholding tax of 20% on reinsurance payments to foreign reinsurers. Maybe just to bring some context to this as well, Zambia currently has about 34 registered insurance companies, whilst it has about 4 reinsurance companies. Most of reinsurance policies are placed outside Zambia. In introducing this withholding tax on reinsurance contracts, what we see is definitely the intention of government to try and grow the reinsurance market in Zambia from the current 4. Also to just increase the economic value of the existing reinsurance companies by sort of penalizing placing reinsurance contracts outside Zambia. The intention is to grow the number of reinsurance companies. Also, the impact will be that we should have more foreign companies setting up in Zambia as reinsurers, as opposed to the current situation. I think they've always had the comfort that they can be set up abroad without necessarily having to comply with any regulations in Zambia. So that has been one of the interesting introductions in the national budget for insurance companies to comply with.
Thanks, Bwalya. I understand there's been some developments proposed for the transport sector. Mutisunge, could you chat to us about that?
Thank you very much. So I do know that the government did make pronouncements around that and will be aggressing your public-private partnerships, to fund and construct transport infrastructure. I think that the spirit in which this is actually being done is the realization that, in public finance, you can't always leave one, side of the equation or one stakeholder to manage, say, infrastructure. If you leave it to the private sector, they're going to charge a premium. If you leave it to the government, sometimes they may not have the funding. So you need both private and public to avert what you call market failure. So you have a bridge that is being built, for example, and it's got social concerns. You put a bridge there, it's going to be used by private players, of course, and then it's also going to be used by individuals. So I think PPPs are the way to go, because what then this means is that you have the private sector playing a key part, and then you also have the state. And it also allows for, aligned types of agendas and when you're, running those infrastructure. Well, at the same time, think of things like your railway. I think we haven't done so well when it comes to rail. Rail is actually going to be very critical because, like Michael did mention, in the mining sector, we're looking at a mining boom. We're looking at 3 million metric tons in the next 5 to 10 years. But that's, that copper, I don't want to say the copper will move from Chambishi to Durban, the copper blisters via rail. No, I want to say copper wires, because we're taking advantage of the electric car era. And I think one thing that really came out of there was value addition. So part of it is actually enveloped in the manufacturing aspect, because if you get your copper out there, it needs to be processed for us to get wires out there. So there is another opportunity there. But then transportation becomes very key, because not only in the agri space, when you do produce whatever you're producing, it needs transport to move. And the other issue around transport that I want to link to manufacturing is cement. Only recently did I learn that a lot of our cement is actually piling up at Mbulungu, because it's actually going to Kenya, the Great Rift Valley area. And the harbor in itself is in a state that is deplorable. There is an opportunity for us to invest in a lot of that type of infrastructure and linked to transport, because waterways are actually becoming very, very key. So the government is also looking to repeal and replace the PPP Act, of course, to make it a little bit more savvy and aligned to the times that we are in. A lot of these legislations that were passed are becoming slowly outdated because the world is fast evolving, and then we need to reflect the ever evolving, landscape in these pieces of legislation. And then completion of Kasama and Bwalya airports as well. These are very, very critical. because I think that when we talk about the cassava base, I mean, how a tour is going to get there. I mean, I think back in the days, we would have SAA or, Zambia Airways, the Boeing 737 would actually be taking people that route. But right now, can't even land properly. So I think the infrastructure there is actually very critical, because some of these transport initiatives that are being spoken about here actually speaks to tourism, and to getting people to tap into opportunity. When you talk about the Northern Block, I mean, there's a lot of things going on. There's that oil exploration in the Block 31, but how are you going to get people out there? I mean, if the airports are, deplorable. And then maintenance, rehabilitation, and upgrading of feeder roads and rehabilitation of economic roads. I think that I want to speak to this in the context of, say, constituencies. And I think that's the reason with which we are seeing a decentralization in economic activity. So economic activity will not be restricted to Lusaka and the Copper Belt, but we're looking at the far spaces in Zambia. Talk about Kawamba, where there's tea, you need roads to get there. Whether feeder roads, whether a fully, tar road and all that. So that becomes very critical. And in other areas, for example, that are linked to mining, I mean, there are areas where explorations are taking place, but guess what? There is no passable road. So you need all those feeder roads to help with transportation of people getting to areas where there is opportunity. And it always starts with the feeder road. First, it's a feeder road that makes people, that is passable and allows people to get to certain destinations. And when economic activity starts to boom, then you put a tar road. So it's a networking issue. So transport sector as well is one that is very key. And if you look at other transport modes that are actually being suggested, they will actually speak to the preservation of some of our roads, because there's been overuse of a tar road, So you look at your rail, there's already acts there that support, is it 30% of bulk cargo that's supposed to move onto rail to preserve roads? And then you also look at your air travel. But I think that in the end, one thing that's also going to be critical, and I want to talk about it now while I link it to tourism, is I think there is this drive to make Zambia the hub of Southern Africa, like back in the days where our airport used to have so much traffic. And I think that is the missing piece in the tourism equation. I know that we talk about local tourism, but it's not that much. But then I think there needs to be that marketing, but then the infrastructure in this area is what is actually going to bring tourists to Zambia. So we sort out our airports, we make Zambia an attractive hub, and I think we'll be sorting out this transport equation. And I'm still bringing out the interlinkages. Thank you, Barry.
Thanks, Mutisunge. It's interesting. It sounds like there's some opportunities in the infrastructure type of and development kind of areas in the sector. So we wait with interest to see what happens. We're going to chat, Bwalya is going to chat now about some of these changes in the context of M&A deals, mergers and acquisition transactions. But before we get to that, Bwalya, just a question maybe that you could assist with. Somebody's asked a question again, going back to the reduced corporate income tax rate. The question is, with companies who have a different year-end approved, in other words, other than the calendar year, when will these changes come into effect? Am I right that perhaps we have to wait for the legislation to come out, or do we know with certainty how this will work?
Yeah, maybe I can step in there and just explain that.
Thanks, Michael.
The changes are really with regards to the charge year. And so if you have a financial year of end in December, so there shouldn't be any problem, because you know that the charge year for the year 31st December 2021, for example, will be the 2021 charge year. Now, these measures will impact the 2022 charge year. And so if you have 31st December as your year end, that is your 2022 charge year. And that particular return, which will be due on the 21st of June 2023, is the one that will be subjected to a reduced income tax rate of 30%. The one that will be submitting on the 31st of June 2022 will continue at the rate of 35%, because the charge year begins from the 1st of January 2022 to the 31st of December 2022. And this is the charge year that will be impacted by the reduced corporate tax rate of 30%. Now, let me answer the question of what about if you have a different financial year end? So if your year end is 31st March, your return for 31st March will be due, for 31st March 2022, for example, is due on the 21st of June 2022, meaning it is a 2021 charge year return. So if your financial year is up to 31st March or 28th February, as the case may be, for the year ending 28th February or 31st March 2022, that charge year is still the 2021 charge year and will attract 35%. The year that will attract 30% is the one that will end on either the 28th of Feb in 2023 or the 31st of March in 2023. That is the one that will be subjected to the 30% tax rate because it falls into that particular charge year. I know as a matter of fact that if your year end is 31st March, then you fall in the previous year charge year. But if your year end starts from June, from July, going upwards, you fall in the following year's charge year. And therefore, if your year end will be 30th September, for example, it means your return for 30th September in 2022 will be at 30% because that return will be due for submission on the 21st of June in 2023 for the year ended 30th September 2022. I hope that it is clear enough because I know that we talk in years, but I hope as I've been explaining, if your year end is 31st October, the 31st October 2021 return will be 35%, but the 31st October 2022 return is the one that is going to be at the rate of 30% because that falls into the 2022 charge year, while the one that will end in October this year is falling into the 2021 charge year. I hope that I've tried to explain how that works. Thank you. Bwalya, you're smiling.
Thanks, Michael.
No, thanks, Michael. I was going to give a legal answer to that. So that was a very perfect answer. Thank you so much. Okay. So in relation, and I think what's also of interest is what is the impact of the national budget on M&A? You know, what pronouncements have been made and how this will affect, you know, mergers and acquisitions going forward. I think what is key, obviously, is, as Michael had talked about, is the introduction of property transfer tax on the transfer of a mineral processing license. And this will be at 10%. So previously, what would have happened is only a transfer of a mining right was subject to property transfer tax. So what the budget proposes to do is to extend this property transfer tax to a transfer of the mineral processing license as well. Now, in terms of M&A, you'd have to then consider how do you structure your transaction? Because the transfer of underlying mineral rights or mining rights will attract property transfer tax at 10%, as opposed to a sale of shares or a purchase of shares, which will attract interest and property transfer tax at 5%. So that's something to think about in terms of the new pronouncements, whether how you will structure your transaction. Will it be a transfer of assets or a transfer of shares? And by trying to do that, you can then try to mitigate the tax payable. Another interesting thing that constantly comes up and that impacts, I think, M&A in Zambia is the issue of taxation or property transfer tax taxation on the indirect transfer of shares in a company. This was introduced in 2019, and I think year after year, we have seen a lot of tweaks to it, whether it's from a housekeeping point or by way of passing legislation just to sort of tweak how that is determined. So basically, the government and through the Zambia Revenue Authority introduced property transfer tax on an indirect transfer of shares. This was obviously a stretch because what we were used to was property transfer tax being payable on a direct transfer of shares. But obviously, I think what we saw here is government noticed that we have what we have noticed is that government was trying to curb people structuring their transactions as indirect transfers and thereby avoiding the payment of property transfer tax. So we have then in 2019, the introduction on indirect transfer of shares. But what it does is that it says, well, for you to pay property transfer tax, the transaction must have a certain level of materiality. And that has been pegged at 10%, that the value of the shares being transferred in the foreign to foreign transaction must be at least 10% of the value of the shares in the Zambian company. And if you met that threshold, then property transfer tax was payable. There is an exemption for where you are reorganizing the business, and the company in Zambia has been part of the group for more than 3 years. In following the 2021 or the 2022 budget, as announced by the minister, ZRA is proposing as a housekeeping measure to say that you will not be liable on a foreign to foreign transaction. You will not be liable to pay property transfer tax if the total value of the transferred shares represents less than 10% of the total value of shares in the Zambian company over a consecutive period of 3 years. So that if, in 1 year you have 5%, another year you have 10, and another year you have 8%, then you would not need to obtain, or you would not need to pay property transfer tax on that transaction. So there's some clarity being provided that it must be 10% of the total value of shares in the Zambian company over a consecutive period of 3 years. In relation to the payment of property transfer tax on an indirect transfer, the responsibility to make that PTT return is on the Zambian company. I think this is some of the questions that always come up in M&A, is where you have a foreign to foreign transaction. Sometimes the Zambian entities will be, they may not even be involved in the M&A per se, but they now have to be actively involved to determine whether or not the threshold has been met to obtain a property transfer tax certificate, and whether or not a PTT return must be made, and then they should make it. By placing the responsibility on the Zambian company, it also means that any penalties would be imposed on the Zambian entity for failure to make the necessary returns. I think, Barry, unless Mutisunge, you have something to add on this, or Michael, but that has generally been the impact. And of course, just the general perspective that we expect to see a lot of M&A activity going forward, whether it's in the mining sector or in the insurance sector, because obviously, as has been discussed, there's a lot of there's an increase in economic activity, as well as foreign direct investment through acquisitions and mergers.
Bwalya, thanks very much. We have had quite a few questions from clients in South Africa on this property transfer tax. I think it seems to be a big issue, perhaps because it's quite unusual. I just wanted to confirm, as I understand, it's not really a capital gains tax, so it's not as though the purchaser gets a sort of step up in cost or anything, but it's a quite sort of different to a capital gains tax. Is that correct? Yes, that's correct. So it is not a capital gains tax. It will apply regardless of whether or not the property being transferred gained in value or not. Okay, interesting. I think we've got time for one or two questions. Michael, maybe one for you. We also have some interest in South Africa regarding the tax treaty between the two countries. It's apparently being renegotiated. Have you heard any news on where we are in that process, or do you have any thoughts on what's likely to happen?
Yeah, no, the tax treaty between Zambia and South Africa has long been pending. There were some negotiations done a few years ago, and the draft a treaty put in place, but I think that that whole has not progressed, and there's likely to be a new treaty now negotiated, because so much time has passed since the last one was actually put in place. So there will be need for fresh negotiations, and so one hopes that with the new government in place, there will be appetite to be able to promote trade between the two countries and put in place a treaty that will support business between the two countries. For now, nothing is in the offing. As a matter of fact, the previous government before the 12th August elections was looking at reducing the number of treaties. As you might have heard, the one with Mauritius was revoked, and at the instance of Zambia, and they are renegotiating several other treaties. They have renegotiated the Island Treaty, and the Netherlands Treaty, and the Swiss Treaty, and there are many others that they are looking to renegotiate, really to provide a little more protection for Zambia. But I'm sure you've picked it up from all our discussion that this new government seems to be more development oriented. The previous one seemed to be more revenue focused, trying to collect as much revenue as they would. This one looks to more be futuristic and look at the development of the economy with a view to be able to get to get more revenues into the future, which is a positive step. And I do think that in like manner, they're going to relook at the tax treaties and see how they can be put in place, especially with trading partners, South Africa, whom we trade with significantly, as Zambia.
Thanks, Michael. Maybe a further question. I think it's probably going to be the last question for you or for Bwalya. Just regarding the BEPS initiative. I mean, I think a lot of our clients in South Africa would like your views as to, or your information as to, you know, what has happened regarding the BEPS initiative. We've had quite a few developments in South Africa regarding interest limitations and anti-avoidance rules, transfer pricing, etc. Any thoughts on what the current Zambian position and perhaps what you see going forward on that initiative?
Yeah, so Zambia has progressed quite a bit with regard to transfer pricing. And I'll speak very briefly so that Bwalya can come in as well. So we do have transfer pricing regulations for all related party transactions. The Zambia Revenue Authority has a fully functional transfer pricing unit, carrying out audits with the help of ATAF, helping with the OECD, helping on audits on the mining sector, Sweden helping with audits on the financial institutions, and you have other jurisdictions helping with ATAF, helping with other entities mining related. It has provisions for taxpayers without borders. They've signed instruments under ATAF that allow members of ATAF to accompany Zambia Revenue Authority on audits. Now we've recently moved to introducing country by country reporting requirements, but there are challenges with some of these legislation, pieces of legislation that have been introduced from a perspective that while other countries have signed multilateral instruments that allow them to exchange information, we haven't signed up to that yet. And so as a result, the Zambian entity for country by country reporting perspective, from a country by country reporting perspective, the Zambian entity is the one that is being required to submit, to file the return in Zambia, while in the normal world, in the ideal world, if your parent company has submitted the C/C reports in their respective country, you use the multilateral instruments to be able to exchange that information. But that is not yet in place, and so that's a negative, but we do hope that maybe going into the future, that's something they'll consider. For now, C/C is also in Zambia, and there'll be an expectation that those eligible companies will be able to file in returns by the end of next year, 2022. And the threshold also has been localized. Previously, we had both the euro as well as the Zambian threshold, but now they're going to be maintaining a threshold of about 4.3 billion kwacha, which, because of the exchange rate fluctuation now, means that some companies that traditionally or ordinarily would not be in scope for country-by-country reporting filing because they are following a euro threshold, which is internationally applicable, may for Zambia be required to be able to still prepare C/C reporting because the threshold for Zambia is lower. So all those things have to be cured, but ought to say that we've advanced greatly from a transfer pricing perspective. The legislation has been rolled out fully in Zambia. Thanks.
Thanks, Michael. Bwalya, any closing thoughts from you on that?
Well, yes. So basically, I think, and to agree with Michael entirely. So we have signed on to the initiative, but we haven't formally become a member. In spite of this, we are still enforcing and trying to implement some of the action plans. And as Michael has spoken to transfer pricing, I think it's one of the key things that we've been doing, and we do that year after year, reviewing the transfer pricing regulations. Another aspect that I think in relation to BEPS that we are also trying to implement is what also Michael mentioned, which is a reconsideration of all double taxation treaties. And I think Mauritius was the first one that we terminated. And the idea there is to also consider the various treaties that we have and to try and ensure that they will align with BEPS. There's several other things, Barry, that I'd love to go on and speak about, but I can see that we are running out of time. So I'll pass it on to Mutisunge if he has any last thoughts.
Thank you, Bwalya. I think the only thing for me is that, look, I know there's been a lot of criticism around the budget, but I think the way it's been dissected, if you look at all these initiatives, I think for the first time in history, we're seeing a roadmap that is very much skewed towards the private sector. And private sector drive growth. When this economy starts to grow, then these other issues, will be addressed, such as, you start to sort out your employment and that. So I am very optimistic that 2022 will be a different year. And I believe that the growth target that was set of 3.5, I know it's good to be conservative, but there is chances that if we sort out the debt issue, would actually even push to higher than 3.5%. So there is opportunity for a lot of players across the sectors, and growth is on the cards. Risk appetite is back in this market. And I think there will be no excuse for not taking any opportunity in Zambia, because I think the die is cast and opportunities are all over. So those will be the few words from me. Yeah.
Thanks, everyone. I think we have come to an end. We've run out of time, but it's great to end on an optimistic note there. Just a thanks to all the panelists. I know it takes a lot of time to prepare for these things, so thank you very much. And thanks for everybody for joining us today. We are planning a similar webinar in the next couple of months regarding Mauritius, more than likely. So we hope you will join us for that one. And thanks very much for joining today. Thanks, everybody.
Thank you.
Thank you.
And
Bye-bye.
thank you all. Bye.
Bye.